Greetings to Dr. RB. We are Group 2F, and today we will be presenting our basic accounting group project for the course A251 BKANK1013 basic accounting. This is our list member of group. We have Lee Paying, Ahmed Shah, myself, Nur Ilyani, Nurdini Hasana, and Choi Kai Shen. Here we have our list of contents. We have introduction, question 1 until question 6, and also conclusion. I will talk about introduction. The purpose of this project is to analyze the financial performance of Heritage Craft Sdn Bhd based on the given scenario. The company operates in the cultural industry and focuses on selling traditional handmade craft and souvenirs. By using CVP analysis, we can study how changes in sales volume, cost, and selling price affect the company's profit. Through this analysis, we calculate important figures such as contribution margin, break-even point, and target profit. We also evaluate different businesses' plans, including changes in sales volume, selling price, advertising costs, product quality improvement, and sales commission structure. Based on the result, recommendations are provided to help the company achieve its target of a 30% net income to sales ratio in 2025 and improve its overall performance and competitiveness in the market. Next, we're gonna talk about cost volume profit analysis, CVP. What is CVP? Cost volume profit CVP analysis is a tool used to understand how cost, sales volume, and profit are related. It helps management see how changes in sales, cost, or selling price will affect the company profit. For Heritage Craft Sdn Bhd, CBP analysis is useful because the company sells handmade craft with both fixed costs, such as rent and salaries, and variable costs such as materials and sales commission. By using CVP analysis, the company can calculate the contribution margin, break-even point, and target profit level. CVP analysis actually helps the company. How? By to know how many units need to be sold to avoid losses, and then plan sales to achieve the target 30% net income to sales ratio, and lastly to decide whether to increase sales volume or adjust selling price or just control cost. This project uses cost volume profit analysis. We act as consultant for Heritage Craft Sdn Bhd. In 2025, the company made 750,000 ringgit Malaysia sales and earned about 105,000 ringgit Malaysia net income. The company wants to reach a 30% of profit ratio. Our task is to analyze cost and sales and suggest ways to increase profit.
So let's look at question 1. Question 1A. Calculate sales price per unit of the product. To get the selling price per unit, we divide total sales revenue by the number of units sold. RN 715,000 divided by 37,500 units equals RN 20 per unit. Next, we calculate the total variable cost. Variable cost change with the number of units sold. Based on the information given, variable costs include variable cost of goods sold and sales commission. The variable cost of goods sold is RN 375,000 and the sales commission is RN 112,500. By adding these two amounts together, the total variable cost is RN 487,500. C. Variable cost per unit. To find the variable cost per unit, we divide the total variable cost by the number of units sold. RN 487,500 divided by 37,500 unit equal RN 30 per unit. D. Calculate the total fixed cost. Fixed cost do not change with the sales volume. The fixed costs include fixed cost of goods sold, fixed advertising expenses, retail expenses, administrating salary, and insurance expenses. When all fixed costs are added together, the total fixed cost is RN 157,500. E. Calculate the contribution margin per unit. Contribution margin per unit is calculated by subtracting variable cost per unit from selling price per unit. So RN 20 minus RN 30 equals RN 7 per unit. F. Calculate the contribution margin ratio. We divide the contribution margin per unit by the selling price per unit. RN 7 divided by RN 20 equals 0.35 or 35%. This means that 35% of each sales index is used to cover fixed costs. G. Calculate the break-even point in unit. Break-even point is when total contribution equals total fixed cost. We divide total fixed cost by contribution margin per unit. So RN 157,500 divided by RN 7 equals 22,500 units. Hash. Calculate the break-even point in sales value. This is obtained by multiply the break-even in unit by the selling price per unit. So 22,500 unit multiplied by Rn20 per unit equals Rn450,000.
So right now I will explain about the question 2, which is the question 2 tell us about we need to determine the number of units must be sold to achieve target income to sale ratio into 30% in 2035. So as we know, our target income is 30% of sale, which is we can write that as a 0.30s. So we use the CVP formula, which is contribution margin times with sale minus with fixed cost equal to target income. So we set up the equation, which is we get 0.35s minus with 157,500 equal to 0.30s. So we move the 0.30s to the left hand side and move the negative 157,500 to the right hand side. So the new equation will be 0.35s minus with 0.30s equal to 57,500. So we solve the 0.35s minus with 0.30s and we get the 0.05s equal to 157,500. So we move the 0.0s 0.05 to the right hand side and only left the s to the left hand side, which is we get the s equal to 157,500 divided with 0.05. So the s we get is 3,150,000 ringgit. So we use the formula revenue, which is sale equal to unit sold times with price per unit. So the equation will be 3,150,000 equal to x, which is we use the x as a unit sold times with 20, which is the price per unit. So we move the x to the left hand side and move the 3,150,000 to the right hand side. So the new equation will be x equal to 3,150,000 divided by 20. So the x will be 155,500 units. So the firm so to achieve target income to sell ratio 30% in 2035, the firm at least must sell the 157,500 units. So let's jump to the question 3, which is selling price per unit if quantity cannot be increased. So we use this formula, which is in bracket Q, in bracket P, minus with VC, minus with FC equal to target income. So Q is quantity, P is a price, VC is variable cost, FC is fixed cost. So we substitute this formula into the equation and we will get the 37,500 times with P minus with 30 minus with 157,500 equal to 0.30 times with 37,500 times with P. So we expand this equation and we will get the 37,500 P minus with 400 487,500 minus with 157,500 equal to 11,250 P. And we settle the 487,500 and minus with 157,500 and we will get 655,000. So we move the negative 645,000 to the right hand side and we move the 11,250p to the left hand side. So the new equation with 37,500p minus with 11,250p equal to 645,000. So we settle the p first, which is 37,500p minus with 11,250p, and we will get the 26,250p equal to 645,000. So we move the 26,250p to the right hand side and only left the p in the left hand side, which is the equation will be 645,000 divided with 26,250p. So the p will get the 24.57 ringgit per unit. So the firm must sell at least one unit is 24.57 ringgit per unit to achieve target net income to sale ratio 30% in 2035.
For question 4, the company plans to improve product quality, which will increase the variable cost of goods sold from 50% to 55% of sales. In addition, fixed advertising expenses will increase by 2,500. However, these improvements are expected to increase sales by 200%, meaning that the total sales will triple from 7,500,000 to 2,250,000. At the new sales level, total variable cost amount to 1,575,000, result in contribution margin of 675,000. This shows that despite higher variable and fixed costs, the increase in sales significantly improved the total contribution. After considering the increased fixed advertising costs, total fixed costs rise slightly to 160,000. When the contribution marginal of 675,000 is deducted by the new fixed cost, the company earns an operating income of 515,000. This profit is sustainable and higher than the current net income of 105,000. Therefore, the company has strong financial potential to proceed with quality improvement plan. The increase in sales volume more than offset the higher cost, making the plans financially viable and beneficial. For question 5, the company have two options, whether or not approve the agent request. For option A, the company consider approving the sales agent request to increase the commission rate from 15% to 20% based on current sales of RM750,000. The total sales commission will be 20% multiplied by the total sales, which is RM150,000. This cost is fully variable and will increase if the sales increase. Compared to the current commission cost, this option significantly increase the selling expenses and reduce the company contribution margin and profitable. Therefore, approving the 20% commission request will increase the operating costs and negative affect net income. Under option B, the company plans to replace the external sales agent with 6 on staff. His staff fixed salary with RM625 per month, resulting in the total annual fixed salaries of RM45,000. In addition, the company pays 5% of commission on total sales, which amount to RM37,500. Therefore, the total sales cost under this option is RM82,500. This cost is significantly lower than RM150,000 commission under option A, resulting in the cost saving of RM60,500 per year. Hence, hiring on staff is more cost efficiency and financial profitable.
Question 6. Provide the management of the company with recommendation for the best strategy to be implemented in 2025 in order to boost the company performance and increase its competitiveness in the market. First recommendation. Optimize the cost structure, reduce variable costs. The company should prioritize controlling variable costs, particularly production costs and sales commissions, as this significantly affect the contribution margin. Also, by sourcing raw materials more efficiently, negotiating better supplier terms, and improving production efficiency, the company can increase its contribution margin without raising selling price. A higher contribution margin will improve profit and lower the break-even point. This is because CVP analysis show that reducing variable costs increase contribution margin, which directly improve net income at the same sales level. Second recommendation, review and redesign sales commission strategy. Instead of increasing the external sales agents' commission rates to 20%, the company should employ in-house sales staff with a lower commission rate and fixed salary. That is analyzed in question 5. This strategy can reduce total variable selling costs in the long run and provide better control over sales activity and brand representative. This is because lower commission rates reduce variable expenses per unit while improving operating leverage and profitability. Third recommendation, use CVP analysis as a continuous planning tool. Management should consistently apply CVP analysis when making decisions related to pricing, cost control, and sales targets. This is to get better forecasting, risk assessment, and strategic planning, especially when market conditions change. This is because CVP analysis helps managers understood the relationship between cost behavior, sales volume, and profit, leading to more informed decisions. Last but not least, focus on value-based pricing rather than volume alone. If increasing sales volume is challenging, the company should adopt a value-based pricing strategy by highlighting the uniqueness, cultural value, and craftsmanship of its products. As heritage crafts operates in a niche artisanal market, customers may be willing to pay a higher price for perceived quality and authentic. This is because CVP analysis confirmed that an increase in selling price will increase contribution margin and operating income even without higher sales volume. All source references are drawn from credible textbooks and journals. That's all. Thank you.
So, in conclusion, based on the CVP analysis, Heritage Craft Senior Berhad is currently making a profit as its sales exceed the break-even point. However, the company has not yet reached its target net income to sales ratio of 30% because the calculation showed that a large increase in sales volume or a higher selling price is needed to achieve this target under the current cost structure. The analysis also highlight how fixed cost, variable cost, and contribution margin directly affect profitability. Overall, CBP analysis provided a clear understanding of the company's financial performance and the impact of different businesses' decision on profit. That's all for me. Thank you.